This is Justin Pulitzer. This is my weekend review for Sunday, May 24th, 2015, although it's being shot on Monday, May 25th, 2015, Memorial Day weekend. Happy Memorial Day, and thank you to all the veterans for your dedication, service, and sacrifice. Anyhow, let's jump right in and start with SPY. So I'm a little zoomed out here, and I'm going to zoom in, but I just wanted to show you that we've been consistently trading in a channel for a while, and we are starting to get into some of the Fibonacci extensions that I had discussed. And let's bring us a little bit more modern in time. I had said in the last video or two that I thought that a pattern similar to the last one was developing, where we would break out of range, kind of look above, and then potentially fail back to the middle of the range here. And you can see that's starting to play out here. You can see there's the consolidation, and we're now starting to look up above range like we did here. And the question is going to be now, do we fall back into the middle of the range, or are we going to continue and extend higher? Now, one of the things I've been discussing for a while now is that we were getting close to these Fibonacci extensions, 1.618 Fib extensions from the 2007 high to the March 2009 low. And you can see that's 213.40 to 214.17, and we kind of top ticked here up around 213.78. So the question is, and I don't have the answer to this yet, we'll only see when price resolves itself, are we going to pop up higher, or are we going to have that rollover? So the way I see it are there's a few things going for the bulls, and there are a few things going against the bulls here. And let's discuss those. One of them, which has sort of been iffy, is the Fed. Now, Janet Yellen gave a speech the other day, and she had discussed a few things. And I think the consensus from the media was that it was a little more hawkish than she's been in the past, and I would say that I would concur to the degree that they're sort of trying to give the impression that they want to raise interest rates. Now, some of the things they discussed is, first of all, the likelihood of a Fed rise in June is very unlikely given the recent data. They are not going to give an explicit warning before the hike, and they are attributing the quarter one weakness as to being transitory, and they were kind of chalking a lot of it up to the weather and to the West Coast port slowdown. Now, we know the April numbers were kind of punk too, so the minutes didn't really cover that, although Ms. Yellen does sound like in her speaking that she is still data dependent. Anyhow, she is expecting the growth to resume. She's attributing that to thanks to low interest rates, consumer confidence, although that has been waning recently in some of the numbers, and then rising incomes, and I guess that would be attributed to the stock market because in the real economy, the real world that we live in, the labor participation rate is the lowest since 1978, and I guess the headline employment numbers are okay, but the truth of the matter is the numbers aren't great. The Fed expressed some fears of high-frequency traders. The decrease in the broker-dealer inventory, I guess that would be thanks to Dodd-Frank and regulations that have made these financial institutions into utilities. And I guess that's also one of the things that has been disturbing that we've discussed, the low volume and the lack of participation, and it's probably because of these institutions are no longer involved. They were also discussing the effects of the strong dollar, oil prices, Chinese slowing growth, and the potential for a Greek exit. So those are that's sort of where the Fed's head is at. My head for the Fed is that their data has not been good, and that they're probably going to be on hold for longer than they'd like to be. I don't know if that means that there's going to be a rate increase in September as like a token rate increase to show that they're, trying to be these, tough inflation hawks, although there really is, in my opinion, no true inflation. The real fear here is deflation. And the impetus, in my view, is that the Fed, if they truly are data dependent, should be easing here, not raising rates. And I guess that would just mean more QE. I don't know how likely that is in the political environment we're in, but I guess we will see. Anyhow, more short term, that's more of my macro view in terms of liquidity. But more short term here, the issue I'm seeing is with the VIX. Now, if you take a look at a lot of the IV in some individual stocks, they are in single digits or even low double digits. And the VIX here is getting close to kissing its reference low, which after an extended period here of low volatility, which we're seeing again, there was a spike up. I believe that something like that is going to happen again. That said, we are seeing lower lows in the VIX. We are seeing a break of trend in terms of volatility, and that's been confirmed. So there probably will be a spike up in VIX, and that'll probably coincide with that move down in the market, which I had been discussing, maybe to something like mid-range. I've been finding it awfully hard to find option setups in terms of the market, in terms of stock plays. And I've been saying, rather than being short premium, the only play really is to make directional bets be a long premium, either on the long side or the short side. Now, just because the VIX is low doesn't mean that we have to roll over. There has to be some type of an IV spike. We could have something like some type of a blow off top where the market just decides to just completely go, full on and do something like spike up to the top of the channel, which would roughly, if it happened on Tuesday, be up around 218, close to 219. I'm not expecting that to happen so easily. If I had to sort of bet my money, I would say something like this is probably a little bit more likely. Just the low confidence and the feel of the tape feels like it might want to back off a little bit. I am, though, on guard for that move higher. I do have some long setups I've been playing, although they are a little bit fewer than they might have been in the past. I've discussed that I like to be long stocks in trending markets or short stocks in trending markets. And I guess that's when I'm most comfortable. But when we're in sort of like sideways chop consolidation patterns, I play for shorter term plays, meaning shorter swings, smaller duration, meaning I'm looking for it to happen in the next couple of days or the next even couple of minutes or hours. And I'm also looking for smaller moves, meaning that if I was looking for, like, let's say 10 points, I might now be looking for 3 or 4 points in terms of the play before booking profits, just because I don't have that market wind at my back per se. I have chop. So we've looked at SPY. The SPY, like I said, is doing so far in this sort of a look above pattern. It hasn't failed yet, so you still have to think that there is the potential for long. It's very tempting to step in front of this short, but I would rather see the confirmed break here and then play for the continuation down lower, maybe to something like the 50-day or the 100-day moving average. If we do break up above these highs, then the bias is still long. A couple of things that are looking a little bit concerning on the market. One is the IWM. We can see we are clearly here now with a little bit lower highs. We are failing on the backside of the prior uptrend line. We've tried to break in a few times, and we are now kind of falling back a bit. However, we are still in this upper distribution of prices. I had discussed down here that I thought we would at least test there and potentially into the middle, which we have, and now we're sort of backing off, but we are still above those lows. I would say if anything below 123.77 starts getting a little bit suspicious to me here, just because these were these hammer lows that rejected so many times. Here you can see the break here was the failure, the retest. We got successful, but a loss again to me would get iffy. It would also be below the 50-day moving average. I've seen a few people post some charts talking about a head and shoulders pattern, the left shoulder, the head, and then the right shoulder. That to me is stretching it a little bit. I don't really see that pattern. I just see the risk of a lower high, and I just see the risk here of potentially rolling over back into range. The key being this 120.97. If we start getting back down there or below, my other reference ranges that I've discussed. I don't want to get into them too much in this video just because they're not in play yet. But I would say below this level here, this 123.77, we have to think that the market is a little bit iffy, just because this to me would have been like a look back into the range of the upper distribution and a fail. Anything above these highs, obviously 127.33 gets bullish again after consolidation and probably would be setting up for the next leg higher. Qs have been relative strength. I think a lot of this has also been because of the strength in Apple. Some of the relative strength in Facebook, although it hasn't felt that great being involved in it. And then Google is just sort of choppy, but you can see we're kind of coming back up to these highs. We're well into the upper distribution of prices here, which isn't really that much. But anything above 109.42 I think is still by the dip. Anything that kind of breaks below here, you'll probably start hearing some double top talk. But I would say that the risk there is likely just to the 50-day moving average and then maybe down to this traverse the range. I would say, to the mid-range, I'm always big on that after we've sort of been in another range to come back mid-range, which is roughly, let's say, around the 50-day moving average. If that fails, we could traverse the rest of the range down to the 106.25 with room to 105.26, and that would just take us back down into this next volume distribution here after this one, let's say, had failed. But not necessarily seeing that yet. I'm going to discuss that when I talk about Apple and Google, and maybe I'll do those quickly now. I am a little bit bullish in Apple. I have been talking about this getting back up to the 133.60-ish area and potentially back up to the earnings after hours highs here, which were 136. So I'm thinking somewhere between 133.60 and 136 is potentially possible if there is some more strength in Apple. This tends to become, I guess, quote unquote, a bit of a safety play for people when things go a little bit awry. But, if the market does completely roll over, Apple will be a little bit vulnerable. I'm currently playing this with a risk reversal call spread, actually. I'm playing long 129s. You can see that when we broke here, I said that I was bullish, 129.85. I backed it with my money, and I'm along the 129, 133 call spread, and short. I believe it's 123 puts down here to finance it. That's roughly around these lows. If we do start rolling over again, I might stop out of it, but I didn't do it super duper huge, and I am looking for that move to be a little bit higher. Google, on the other hand, has been really a choppy mess. It never really got down to the full area that I would have liked to have seen it correct to, so the launching point has been a little bit more suspect. If you are long Google, I can say that you can hang your hat on the fact that it is above this 553 area, like this 545 to 545.41 to 553 area is like the buffer zone and key to stay above for still higher prices. It's also roughly hanging above the 200 and the 50-day moving average, so if you're playing long, you can use that for sort of a right or right out. The encouraging part here is the lows are starting to get a little bit higher, and the highs here are starting to get a little incrementally higher. So there might be some Momo in Google if it can start continuing this pattern higher. Although I will see some, I still consider it just range until these areas break, of a solid break over this like 580 to 585 area, I would say needs to break to see, into the 600s. Another area that's been very controversial, I've been saying that I thought it was coming into support and it would be getting kind of setting up for buy the dip. And we started to see those levels, although we didn't really get the full extension I would have liked to have seen to the channel lows. So this rally might be a little bit suspect and choppy, but the TLT is sort of starting to catch itself a bit. The risk I see on the upside is to be a test of the backside of the prior uptrend line here, which could maybe coincide with a 200-day moving average and maybe the 2009 crash peak, which was 123.15. This is still considered relatively high, believe it or not, for for TLT. And I know a lot of people are talking about the TLT going lower and that being bullish for stocks. But the truth of the matter is that stock prices are valued on what's known as a discounted cash flow model, DCF for short. And part of that calculation is the risk-free rate, which are interest rates on treasuries. Depending on how it's calculated, some people use 10 years or 30 years. I mostly use the 10 years when I do it. But the rise, let's say, of TLT and the lowering of interest rates is good for stock prices. This is why we are at all-time highs. Coming down here a little bit, I still think is kind of quote-unquote okay. If we start getting really below the channel here, then I would say that things are starting to get a little bit out of control, and the interest rate environment could be deleterious to stocks. A rise, though, of TLT would probably be good for stocks like the dividend stocks, you think utilities and such, because they have less competition. Crude oil, I'm actually rather bullish on. The consensus here is that it's topping out and it's getting ready to roll over again. I just see this as consolidation. I do think it is possible that there is a pullback to test the breakout of 54.24, but I do believe, and I've been saying this on the stream and I've made this call, that I think we are going to see $75 in crude oil. That was really where this major breakdown took place, roughly up about here. It's also the 50% Fibonacci retracement of the entire move from, the chart doesn't go back that long, but from the highs down to the lows, and then a bounce back would take it up to the 50%. At the very least, a 38.2 Fibonacci retracement, which does coincide roughly with the 200-day moving average, is where this breakdown took place. So I am expecting higher oil prices, with the caveat that there might first be a rollover retest to the 54s. But I do think that the path of least resistance for oil at this price is likely higher. If we start losing the 54.24, then I might rethink my thesis and actually really reevaluate my view on the economy. I would think at that point that things are getting significantly weaker and that Fed easing might even be more likely than it is now. One more macro type of thing to discuss is the IBB. You can see it's done something here that it hasn't done for a while, although albeit tentatively. We are roughly looking above the prior downtrend line, although I really am stretched to call this a downtrend. It's really just been a flag consolidation for me up near the highs, and it had just run into some channel resistance. So there are a few ways for excesses in price to work themselves off. One are complete moves down, like traversing to mid-range or even to the lower part of the range, or just sideways action to burn off some of the sort of hot money that was in here, like with the Biogen IDEC blow off. So anyhow, we are looking above there. It still has yet to take out this prior swing high to form that W pattern, which would have me thinking still higher prices. So as you see, I have my alert set at the 368.26, and if we can get above that high, then I would say it's sort of a little bit more game on for biotech. I have been playing it rather bullishly, though. Even though I have been cautious, I've been talking about Gilead being bullish. I had said that it was going to be added to my buy the dips list. Once I saw that it was starting to make new highs, it did promptly decide to roll over and then rally again. So it did. This has been the pattern, though. Stocks are reporting good numbers, like Apple reported good numbers. Initially, I guess everyone had already, in this case, I can't say that everyone had played long as it sold off into the number, but people were quick to take profits. Unlike Apple, this did have overhead supply. You can see all of the people up here who had been wrong used this to kind of get their money back and flatten up, and then the stock was sort of free to rally again. If Gilead does decide to roll, I do expect, by the way, Gilead to retest the old highs up here around the 216s. I just don't know if it's going to be the straight shot higher or if we're going to have to kind of retest the breakout before that happens. Either way, I would say your first lines in the sand are this gap fill area of this 208.45 up to the prior high here of 109.49, which you can see had roughly held on this pullback. If there is a move a little bit lower into range, I do suspect that the 105s really, not just this 105.95, but the 105s in general should support now if the stock is healthy. That had been resistance, it should now be support. I would say on some type of a really crazy market spike move, I would give a little give into the 103s just because that's mid-range before saying that the stock is bearish. But that area really should hold, and you can see this confluence of moving averages moving up. They are now roughly in the 103s. By the time it comes down, maybe they are in the 105s. I am right or right out by the dips on these types of moves. Given that we had the inverse head and shoulders breakout, it may just want to retest the breakout point there. Although Gilead, like I said, I am still by the dips. I am just a little bit cautious about chasing the rips given how many days it had gone up. We are starting to get a little bit of sideways consolidation, which is good. I like to see that for the health of stocks. But if you sort of didn't catch it down here when I had discussed it, it's getting a little bit late risk reward wise, playing for the last few points given the responsive nature of the market. People will be likely seeing this and looking to book profits up there. If you're long, I would stay long, looking for that with a stop now below this hammer low here, below this 108.15. Anything below there to me, I do think we're going to see the 105s again. So that is Gilead. We already did Apple and Google. Let's hit up Amazon. Amazon did the 50% fib bounce. We're now making a bit of higher lows, but we have not made higher highs. This is also a bit of a funny point seasonally for Amazon. They tend to be more bullish in the holiday type of a season, not so much in the summer with the retailers. If retail does start rolling over, Amazon might want to roll over with it. If you're currently long Amazon, you have very defined stop out points here. I would say the 418.36. For long trades, I wouldn't really want to be long below these lows. And if you're looking to add or if you're looking to initiate, above this 439 would form that W pattern, and I believe would get the stock back up to the old highs of the 450s rather quickly. I have been discussing for a while, and I don't know the time frame that this happens in, although the sideways consolidation is rather bullish. I do think it's going to get close up to that 1.618 Fibonacci extension at 484.73. That maybe it coincides with the channel highs when it gets there. It may need earnings to get there, or it may just want to resolve higher. So if we do get above these highs here, the 452.65, I do think that Fibonacci extension is going to come into play. So that is my view on Amazon. Let's go to the Chinese stocks for a little bit. I know how much people love these. BABA. I've been playing this long, actually, right here with the break of this earnings gap. I had said that, the earnings gap, it came right to the channel. It consolidated here. A lot of people wanted to jump the gun. I had said that the risk was lower until that high of day was taken. We took that here on, I believe that was the Wednesday. Then you had the Thursday continuation, and then Friday just some consolidation and chop and likely some option pinning. So if you're really, really kind of shook one, afraid money, you don't want to see it get below the IPO price, which was $92.70. That's also some of the selling that I think took place here. Some of the people who got long in the IPO, it's also getting close to this swing low here. It did actually get up into 95s. So 95.52 around here, roughly, was some people were probably made whole. I am looking for this thing to fill the gap, though, to somewhere between 98.45 and the even number of roughly around 100, which would be the 50% Fibonacci retracement. So I do think that that's where the stock price is headed. If you didn't catch this, what you want to see here is some sideways consolidation before initiating, or a move above these highs sort of to continue to play continuation. The IV, like I said, has been very low in the market, so if you want to do it, maybe some call spreads are the better way to do it, rather than maybe owning common. If you want to own common, just use stops, I would say, are really key for these stocks. Baidu is was hovering around these lows. This actually looked like it was going to consolidate here and break down further. I had been looking for it to make a move to the channel low, but rather than do that, it decided to hold out here roughly a little bit around mid-channel and then come up to the channel high. That also coincides, if you look, where the volume distribution begins, where the breakdown was. You can see all this consolidation and chop, and then we had the breakdown. This is sort of the check back. And the presumption here would be a rollover again, that the stock would roll over now that these people are made whole. It's a little tricky to time the entry of this and how to play it. There are two philosophies here. You can play it right here off the channel high. Maybe if you want to wait for, maybe there's some type of a pop on Tuesday to the 50-day moving average, or you can initiate somewhere in here. The risk, though, is that it does something like want to move mid-range here. That often can be the case. That was also the scene of this breakdown. So I would say that it's kind of right or right out, somewhere around the 50-day. If you want to do maybe half size there, and then maybe add here, just with the thought that it could get mid-range, and where the gap starts. Also, the backside of this old up channel that it broke down out of, that could be a check back point. So that to me would sort of be the better entry if there is some continued strength, particularly with multiple days up. Like it would be great if it did this like in a straight line and then played that right or right out. I had discussed how to play this. I think that the safest way and the cheapest way is to do it with maybe with some put spreads. There are two ways. The ones I saw that I believe you can get for less than a third of the width of the strikes were the 205 190s or the 200 190s. Depending on how much you're looking to pay, I would go maybe 20 into the no more than in the high 20s or the mid 30s in terms of days to expiration. So that is what I'm looking for here. I would think that the impetus, in my view, would be some type of a rollback over. But I would caution that there is some risk to maybe to the mid-range. It's also possible that there's a gap fill, but this to me looks really weak. I mean, the stock came down. You've seen the consolidation here, consolidation lower. Now we're just in this ping-pong range. You can see when we broke down here, it had multiple tests of that area that failed, like the fallback. So maybe it does something like this, like this again. I believe that to me seems like the pattern we're in. I think patterns work until they don't. So like I said, I think that this sets up nicely for a right or right out type of a short play. Facebook. This one has been bull flagging here. It has been suffering, though, from the 50-day moving average and also 81 between 81 and 82 sellers. Where did those come from? You can see these were the reference highs, the 81.16 and the 82.17, and we topped roughly between that area. So there were probably a lot of people who had bought up here who were kind of chasing. They were wrong, and now they're just getting their money back. I believe longer term Facebook is to see higher. I've been discussing it at infinitum that I do think it sees 100 at some point, but it's been suffering from some relative weakness in the social media space. Twitter and LinkedIn have been getting their the stuffing knocked out of them, and a lot of those chasers have been out. Right now, we're currently mid-range. I would say if you're kind of a scaredy cat in Facebook, you don't really want to see here below the 79.46. This was this low. If you're looking to add or to be bullish, you really do need to see it clear this 81.85 to kind of complete the flag for a move probably back up to the highs. I would think that 83s, 84s, and then 86s would be in play. So longer term bullish, short term just cautious as long as we're below the 50-day and below this this kind of spike up breakout high. But to me, it looks like it will resolve higher at some point. Twitter, not so much. It's broken trend. It's just been kind of kissing the lows, and it's just been looking like it wants to come back and retest these lows around 36, maybe even 34.62, which were these. You could see after the last breakdown in earnings, the stock went sideways for a while, did go lower, and then just kind of like chopped in a big range for a while before going higher. I sort of believe that will be the case. I've said it before that I do think Twitter sees some type of a move back up, maybe close to the 50% Fibonacci retracement area, which would roughly take it close to 45. I've been saying between 44 and 46. So 44.78, 45 is roughly in the middle. It's also where these volume distributions separate. You can see the next one starts here. I believe that'll happen. I don't know what it's going to take to get there. Either it'll be likely earnings or news. So I'm just keeping my eye out for that. I believe you could kind of nibble Twitter here if you want, although there is risk of further breakdown to the 100% retracement, which, let's see if I don't know if I can see it on this chart. Let's do 2 years daily. You can see was back here. The all-time low here was 29.51. I don't know if we're going to get all the way that low. It does feel, though, that there was a lot of people in here who were chasing, who thought we were going to get the channel highs right away. I had said that I believed that they needed to show 2 solid quarters back to back. They did not show that, so we have just traversed back into this area. I think that you can kind of buy a little nibble here, but be in the sense that it's probably going to take a while to resolve. I do believe we're in this throes of this type of a pattern where there's going to be a lot of chop. Although this has been, like I said, a steady seller lower. But longer term, I do think that the stock will see some better days. LinkedIn, also very disappointing off of earnings. It had a large move down. We are now back into this chop area. It's roughly trying to fill into like this area here where these reference lows were. I think that the stock will likely bounce at some point to retest the gap. I do think, though, that there is risk, and I've been sort of waiting for this. I hate to say hoping for it, but I've been hoping for a test of the primary trend line down here in like the 170s. I think that would set up for a great right or right out type of a long to play in size for some type of a bounce back. But, we are getting close to on one time frame, the 61.8, so that's probably getting some responsive buyers into here. I think a lot of this, the people who were long and wrong up here are just kind of washing out, and the stock is just, again, going to just kind of consolidate and chop sideways for a while. You can see after the earnings gap higher, it did that. And again here also, so that's just the pattern of this stock to kind of consolidate and chop. But I do think the risk is to the move to the primary trend where I would be a right or right out buyer. FireEye, this has been a fairly bullish stock and one I'm actually sort of starting to like. You can see in the scheme of things, it's had a very long base here. It's been basing for a while and looking like it wants to kind of it's poised to break out. I do believe that the story here is real. I didn't like their management for a while for doing secondaries and things when the stock price was high, although it was good for their company. It was bad for their shareholders. You can see, though, we are breaking out of this downward pattern. The stock looks like it wants to retest these highs, and I believe test higher. So I'm a buy. You can see from higher lows, looking now to make higher highs. I think that the bias in the stock is still higher. Do keep in mind, if the market rolls over, these stocks probably won't be immune, but I believe the hacking headlines are only on these guys' side. The same thing with CYBR. This one hasn't really fully shown its hand yet with still higher highs, but is consolidating above the high, like in the upper distribution, so to speak, of the range. If you're long this, you want to be a little careful if you lose 59.42, which is down here. These lows, also the 50-day. But I believe that these stocks are also going to resolve higher eventually. Be nice if I could type properly. This Palo Alto Networks also getting a little, getting some lift. I believe Palo Alto is probably the best of breed, and it has done a lot of holding of its 50-day moving average. Now, it's done this on multiple occasions. We are making new highs. I actually need to redraw my Fibonacci retracement. This is a little bit old and had been done intraday, but we are going higher. So they have earnings coming up. The stock's going to move rather large. I don't really like gambling on earnings. I sort of like to, unless there's been such an extensive move, like a blow off top ahead of time or like a complete cratering ahead of time. But I would say that this stock, if it does have some type of a gap down, I would be looking to buy it since we know it holds the 50-day moving average well. I'd be looking for a 50-day moving average by the dip type of a scenario, or to sell out of the money puts on a move down to the 50-day moving average, preferably on a spike high. So I believe that the stocks will eventually see higher, but I am cautious to chase. I prefer buying the dips. Green Mountain Coffee Roasters. This is one that had a head and shoulders breakdown, a failed check back, and is now completing the pattern lower. It actually did complete the pattern depending on how you measured it from which peak. These were this 99.85 to 96.21 was the head and shoulders top completion. The breakout level that it had seen before was this 89.66. We're roughly around there now. But the real key level to me was where the Coke bid came in, and that was around 80.88. So I believe on any move down lower into that area, particularly after this protracted selling, that the stock could set up for a great right or right out long versus that Coke buy-in level. I'm sure a lot of traders are thinking like myself. Maybe we don't fully see there because people step in a little bit ahead, but somewhere between in the let's say in these next 10 points, if it does wind up lower, I think that would set up to be a great buy the dip area for Green Mountain Coffee. If you're short, for sure an area to be covering into. IBM. It would also help if I could type out the symbol. I think that this has been, I said was going to fill the gap. It's been consolidating inside the gap. I was really looking for it to kind of roll back over to get a buy the dip type of thing around 165. That has not happened. Since then, we are just in a bull flag pattern. The, I guess, thinking here is that it will continue higher to fill the gap up here, particularly since we know Warren Buffett is adding. He's got their back. So if you're long, you just needed to see it hold 170.33. Anything below there to me gets a little bit iffy because you're back into the gap. If you lose these lows here, this 168.84-ish area, we will see that 165 level and maybe even a move a little bit lower into the mid-range, into the 160s. But this stock to me looks kind of bullish. Again, my concern is again because of my view of being about the market potential vulnerability for that spike in IV. Stocks like IBM might not be spared. But again, looking rather bullish. Netflix. This stock has been an absolute beast. I mean, the stock is just, it got here in gaps. It's been stronger still. A lot of people have been trying to step in front of the short. At some point, the stock is going to roll over. I think we all know that. It's just a matter of when. I think there are so many buried shorts in here that they just can't get the stock lower. It did achieve my 1.618 Fibonacci extension, which was 596.67. I believe that there will be some type of a rollback over in this stock at some point, maybe before earnings. People are scared. They want to take some profits, and it may test into this range. I'm not saying that I would step in front of the short. If you do it, maybe with some put ratios, or just flat out put spreads. That's sort of the scenario I see having happening. But it is possible that the stock wants to continue higher. It is in free air. A lot of the mistakes that people make, and I wouldn't say I might have been guilty of this earlier in my career, not so much now. But people think just that stocks are too high to buy, so they must be ripe to sell. There is no overhead supply here. Anyone who has ever been short Netflix is collectively wrong. Anyone who's ever been long is collectively right. There is no outside pressure on the stock to push it down. It can stay up here a lot longer than people probably realize. The news flow, though, has been all roses. I would say that I tend to like to sell when things are high and when the news flow can't get any better and everyone's bullish, which is now. I would, though, say that this is still a buy the dip stock. Look for this thing to come back down maybe into this earnings gap range, and that will probably set up for some type of a buy the dip. I don't know if you're going to get the full gap fill. It's possible on some bad earnings news, but the stock is still rather bullish. Tesla. One I am still bullish on for still higher prices. It's consolidating a lot. This also partially is because my view on crude oil is bullish. I think that as long as crude is bullish, that Tesla will go higher. I am looking for a gap fill to 257.70 and also a move to the 265. At that point, it's kind of let's see. It's a little wait and see because that had been the old high in the stock before the move last summer up to the 290s. I do expect there to be new highs in Tesla, actually above the 291 to 300 level. It's just a matter of how it gets there. So I'm a buyer of Tesla on dips. I'd like to see it, either consolidate sideways a little like it's been doing, which is nice, before the next move higher, or some type of a pullback just to show us that it can still make higher lows. It's been making higher lows and higher highs. That's what I like to see in momentum stocks. So Tesla to me is buy the dip, and I am looking for a bit higher. Visa has been a little bit frustrating. I have been discussing that I'm playing this with call spreads. I bought this for like $1, so I don't like to say I don't care if it doesn't work, but it's not going to be the end of the world if it doesn't. Was just looking for a move to the channel high. The longer it consolidates here, the more pressure it builds, the more explosive the move would be up higher. At the time when I had entered it, the channel I think was in the 63s. Now it's roughly getting into the 70, close to 75s. So I am thinking that Visa is looking like it wants to go higher. If it doesn't go higher for me here, what am I thinking? Let me show you. The chart isn't cooperating so well. There we go. I do think that it could potentially pull back to fill the gap into the 61.8 Fibonacci retracement, where at that point, if it would be soon and coincide with the 50-day and the channel, I would be interested in attempting again for another kind of picking my spot for a write or write out type of trade. I might do this in shares or to sell some out of the money puts or both, or some type of a combination. But I do think that we've seen the highs here 1, 2, 3 and just consolidating up here. It does look like it wants to go still higher, although it is being really rather choppy. The way I bought those call spreads tells me that a lot of people don't have a lot of faith in it because they were so cheap, and it may just be choppy. I do think higher, but am looking for the potential for lower. I like risk-defined trades since the options are so cheap. MasterCard also really just choppy, finding a lack of finding new buyers, although we are still in this wedge. And, again, another one that looks like it has potential to go higher, still higher into the wedge. You can see we're kind of just roughly chopping around these highs, consolidating. There wasn't a sharp back off. It could still go higher. If you're long this and you're careful, this 91.83 hammer here, roughly this area between there and the 91.58. So between this area is kind of the stop out. If we get above this 94.33 area, I would say that we will see that that sort of wedge high rather quickly. This thing might have 100 written all over it by the time it gets there. So anyhow, that's my weekend video. I hope you guys found it useful. Please be sure to hit the like button on this video. That's the thumbs up. Leave me some comments, and favorites and retweets are always welcome. Be sure to follow me on Twitter. My handle is @JustinPulitzer, and let's have a good week.